measuring value. Before expiration, however, this maximum value can be reached when both options are fairly well in the money as expiration approaches, and each option is trading for its intrinsic value. If you buy and are long a vertical spread, the most it can be worth is the difference between the strike prices. Your potential profit would be the difference between its sale value and the debit you paid for it. If you sell and are short a vertical spread, you want both options to expire out of the money and with no value. In this case, you'll keep the premium received from selling the spread in the first place, your maximum profit. However, if your market opinion on the underlying stock is incorrect, you can close out or buy back the position and cut your loss before expiration. We would like to thank you for taking the time to watch the videos that we have put together for you today. Take a look and subscribe to our YouTube channel, our Instagram, our Facebook page, and reach out if you have additional questions. We would love to hear from you. Check out our website for more information. Go to www.optiontradersnetwork.com. Thanks so much.